The greatest economic collapses in history, the events that shattered nations, toppled governments, and pushed millions into poverty, were not caused by what you think, not by a single bad president, not by one catastrophic war, not even by greedy bankers acting alone. What if the real causes of every major economic depression, from the panic of 1873 to the Great Depression of 1929, to Japan's lost decades, and even the 2008 financial crash, all follow the same hidden blueprint? A blueprint so old, so deeply embedded in modern finance, that even today's policymakers continue repeating it. This is the story of the world's greatest depressions, and the uncomfortable truth behind what actually caused them. And by the end of this video, you'll see a pattern so obvious, so universal, that once you see it, you'll never be able to unsee it again. To understand the depressions of the past, we have to step back to a time when global finance was still forming. In the late 19th and early 20th centuries, economies were exploding with new technologies: railroads, factories, steel, electricity. Bankers like J.P. Morgan, economists like Irving Fisher, and politicians like Franklin Roosevelt shaped early financial systems that still influence the world today. But behind all this growth lay a fragile foundation, a banking system built on leverage, governments tied to rigid monetary systems, investors driven by collective mania, and policies that unintentionally amplified every shock. Here's the twist. Each depression began with something that looked like progress, not failure, a boom, a miracle, a golden age. And that is exactly why people didn't see the danger coming. Origins. When good times create bad incentives. Every depression in history starts the same way, with optimism. Panic of 1873, the railroad bubble. The US and Europe believed railroads would reshape the world. Money poured into new lines, new companies, new technology. Investors thought nothing could go wrong. Until suddenly, growth outran reality. Railroads expanded faster than demand. Companies borrowed more than they could repay. When one railroad went bankrupt, confidence collapsed, triggering a global depression that lasted 6 years. 1920s. The Roaring Illusion. Fast forward 50 years. The U.S. entered the Roaring '20s, a decade of unstoppable optimism. Cars, radios, skyscrapers, everything felt new, modern, and profitable. But beneath the excitement, consumers were borrowing more than ever. Banks were lightly regulated, stocks were bought on margin. With only 10% down, it looked like prosperity, but it was built on a mountain of debt. Japan in the 1980s. The miracle before the meltdown. Japan became the envy of the world. Its stock market soared, real estate prices skyrocketed, and corporations borrowed endlessly. The government and public believed growth would never end. They were wrong. Their eyes, how small risks turn into systemic fragility. Here's the uncomfortable pattern. Prosperity encourages risk. Risk inflates bubbles. Bubbles create illusions. And illusions become policy. The common thread across every major depression. 4 ingredients appeared just before collapse. 1. Rapid credit expansion. 2. Asset prices detached from reality. 3. Overconfidence in new financial models. 4. Governments or central banks that wait too long. This is the moment when the system becomes fragile, but still looks healthy. Think of it like a tall building built on wet sand. It stands beautifully until the pressure becomes too much. The breaking point. The moment everything snaps. Every depression has a trigger, but the trigger is never the true cause. The real cause is the fragility built up over years. 1929. The Great Depression begins on October 24, 1929. The stock market began to fall. It didn't happen in one day. It was a slow-motion collapse. But once panic started, margin calls forced investors to sell. Selling triggered more selling. Banks began failing. People lost savings. Businesses closed. A downturn turned into a disaster. 1991. Japan's asset bubble bursts. Real estate prices in Tokyo were so high that the land beneath the imperial palace was worth more than all of California. Then, when the Bank of Japan raised interest rates, everything cracked. Banks collapsed. Corporations drowned in debt. Japan entered a lost decade that lasted 30 years. 2008. The global meltdown. Housing prices crashed. Leverage unwound. Banks failed. The world froze. Every collapse looked different on the surface, but identical underneath. Fallout. When the economy enters the free fall once the collapse begins, a depression follows a predictable chain reaction. One credit dries up, banks stop lending. 2. Businesses cut jobs. Unemployment soars. 3. Consumers stop spending. 4. More businesses fail. 5. Asset prices fall even further. 6. Confidence evaporates. This spiral feeds on itself. The Great Depression example, unemployment hit 25%. Over 9,000 banks failed. Global trade collapsed by 66%. Industrial production fell by half. People assumed the system would never recover. And yet, failed fixes. Why governments make depressions worse. History shows a chilling truth. Governments often worsen depressions before they fix them. During the Great Depression, the U.S. raised tariffs, Smoot-Hawley. Collapsing global trade, the Federal Reserve tightened credit too early. Taxes were increased. During recession, countries clung to the gold standard, restricting money supply. These decisions turned a recession into a decade-long catastrophe. Japan in the 1990s, interest rates were cut too late. Banks weren't forced to clean up bad loans. Zombie companies kept alive, drained the system for years. The result? 30 years of stagnation that Japan still struggles with today. 2008. Response. While many policies helped slow the collapse, others inflated new long-term risks. Massive national debt, asset dependency, and moral hazard. Modern parallels. The pattern continues. Now here's where history becomes uncomfortable, because the same warning signs are appearing again today. Modern red flags. Global debt has surpassed $315 trillion. U.S. national debt is over $38 trillion. China's real estate market is collapsing. Housing bubbles exist from Canada to New Zealand. More people invest using borrowed money than ever. Artificially low interest rates created a decade of cheap credit. Governments rely on printing money to avoid crises. These are the exact conditions that appeared before every historical depression. The shocking pattern. Every Great Depression begins with too much debt, gives too much optimism, gives too little regulation, gives one sudden shock, and right now, all four exist simultaneously at a global scale never seen before. 3 clear takeaways. 1. Every major depression begins in a time of prosperity. The danger, isn't the crash. It's the years of unchecked optimism that preceded. 2. Debt is the silent engine behind every collapse. When households, corporations, and governments borrow beyond sustainability, the system becomes fragile. 3. Crashes don't break systems, they reveal them. The cracks were always there. The collapse just exposes them. Final warning, open-ended thought. History doesn't repeat itself perfectly, but it rhymes with frightening clarity. So the question isn't whether another major depression will happen. The real question is, will we recognize the pattern before it's too late? Or will future historians look back at our era and say, we ignored the same warning signs as every generation before us? Natural, educational, none. If you found this breakdown valuable, and want more deep dives into the hidden forces shaping our financial world, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future episodes. Your support helps this channel continue exploring the lessons history keeps trying to teach us.